All right. Welcome, everyone. Welcome to boot camp drill number 4 for our options boot camp. Glad to be back here. I'm refreshed after a good break. Was kind of getting bored, so good to be here. And today we're going to talk about the checklist for trade entry. This is our boot camp session number 4. And also we will focus on what are some of the trading strategies that we can use for small value accounts. So those are the two main topics for today. But before we begin, Happy New Year to you all. Welcome 2021. We have kicked 2020 out in the history. Let's put it in the history books and forget about it. I know we still are reeling with the impact of 2020, but things are looking better. From vaccination perspective, from economy perspective, hopefully things will get better and we will return to new normal. I don't know what that new normal would be, but whatever it is, things won't stay what those were in 2020. So I'm looking forward to see what 2021 brings for us. Happy New Year to you all. So let's get going. This is our first session for 2021. So before we start, please note that this is not an investment, financial, or tax advice. Anything that you see and hear in this session or in the deck is only for education purposes and maybe a little bit of entertainment. But nothing is here as a professional advice. So don't trade based solely on what you hear and what you see. Talk to a professional before you make a decision. All right, I do see some new names. So quick intro about myself. I've had more than 2 decades of experience in software industry, mostly around fintech and big data management space. Being investing for 15 years in stocks, ETFs, very active in options for 5 years. My way of investing is think risk before rewards. So I don't take undue risky trades. My intent is not to hit it out of the park, not to run for big treasure hunts. I want to generate consistent income and grow the portfolio over time. That's the way I trade. Based out of Bay Area, San Jose, California. For past 12 months, I exist only in Zoom. But I'm hoping that I'll start meeting people in person very soon. Outside of these sessions, the bootcamp session and the Saturday session where we talk about general investing, you can connect with me on podcast. Just search for OptionGig. Plus 20 these holidays, I become active on Twitter. I wasn't that active, but I really like Twitter. Started exploring it and I'm liking it. So I've started becoming active on Twitter. Plus on YouTube, you can search for OptionGig. We have a channel on OptionGig. And of course, the website, email, or on Quora. So what are we going to cover on bootcamp? Let's go through it. I see some questions around it. So let's look at the bootcamp, what we're going to talk about. So overall, a lot of topics to cover on bootcamp. Till now, we have already covered the very basic ones, talking about option contract, put option contract, cash secured put, call option contract, covered call. In the previous session, we talked about moneyness of option contracts and how the overall assignment and exercise process works. Today, we're going to talk about a trade opening checklist and also some of the strategies that we can use on a small value accounts. So there is a question I see. Will you also cover mini options sometimes? Seems very useful for beginners like me to keep the transaction size small. So wait for the session when I talk about small account trading strategies. So in that, you will be able to understand even on a small value, how account, how you can trade any options. Okay. So mini options only exist in very specific tickers. For example, E-mini options. Um, so if you only stick to so-called mini options, you will not have many choices of tickers that you can trade on. So I don't deal in mini options. I rather use other methodologies that we're going to talk about today to keep the transaction size small. After that, we're going to talk about a little more. Some people say it's a complex option strategies, but as you do it, you say it's nothing complex in there. Everything is created using calls and puts. So we're going to talk about iron condors, iron fly, butterfly, strangle, straddle, ratio, back ratio, jared lizard. I mean, there are all the animals of the zoo. You can put it in an option bucket. But we're going to talk about some more multi-legged option strategies. We'll dig a little deeper into option pricing, and then also talk about when to exit. What's our exit checklist? Today's session, we're going to talk about entry checklist. Subsequently, we'll also talk about how to exit. And then we get into the details, little more advanced topics of trade management. You know, if a trade is going against you, how you manage your option trades. For that, we also need to understand some of the Greeks, delta, theta, vega, gamma, and how to manage a risk using options. And then once you have your portfolio, which has got stocks and bunch of options, how do you manage your overall portfolio like professionals? And lastly, some tips and tricks that you won't find in any book. Those are, because I've been trading options as a part-time investor for many years, some things that I find useful for me just as a part-time investor, I want to share with you. So that will be the overall what we're going to cover in the boot camp. So a lot of stuff still to come. So stay here with me. This is a long race. This is a marathon. This is not a sprint that will be done in a session or two. Okay. So in case if you have missed previous sessions, you can go to the website. The recording is available on the website. You can go to my website, optiongig.com. Register yourself as a member by signing up. Go to menu members and a boot camp. You should be able to see under members. Once you register, you will see boot camp, and there you should be able to see the recording of previous sessions. So drill number 3 is already there. In a couple of days, I'll also upload today's session. So what are we going to talk about today? We're going to go through the checklist, which is worth making muscle memory. Can't emphasize enough the importance of the checklist and going through it in your mind before you open a trade. Then we'll keep some time for Q&A. Then we're going to talk about the strategies for small accounts and then Q&A on that. So why it is what's the importance of opening the trade, right? If you have been a stock trader or stock investor, we do think about opening trade, but then not as much as it becomes important if you are selling an options. The reason is, for us as an option seller, this is the most important part of overall trade cycle. And this is a big difference between an option seller and a stock investor. In a stock investor, once you have bought the shares, the later, what happens after that determines your profitability. How high the share goes determines your profitability. So in case we're buying the shares, hey, it's okay if I bought it at $2 higher than the optimal price. But if the stock goes $50 up, doesn't really matter whether I made 48 or whether I made 46. It's not big of a difference. But when you're selling an option, your overall profitability, the maximum amount of money that you can make, is determined by the amount of premium that you have collected. So we already capped your maximum profit. So that is why we have to be careful when we are opening a trade, specifically as an option seller, because we are capping our profitability. So we want to make sure that we are putting our best foot forward at that point of a time. Because once we have created a trade, after that, it's all about management. We cannot make more money than what the premium that we have received when we opened the trade. Now, there are some complex trades, ratios, spreads, etc., where I won't get into those right now. But most of the trades that we do uh, as an option seller, our max profit is already determined at the trade opening. So we want to make sure that the conditions are optimal. The pricing that we received is great because that's the maximum profit we can make. And that is why it is very important. This is, I would say, the most important step in the overall option trading cycle. So cycle would be opening an option, managing it if it goes against you, and finally closing it. So out of those three steps, the most important is the opening one. How you open the trade will make all the difference in the profitability. Of course, if stock cooperates, then it's fine. But as an option seller, we don't only depend on cooperation from stock. If you have been attending the Saturday sessions, I bring an umpteenth number of examples where the stock has gone against my directional sense. I talking heads on CNBCs, Barron's, Investor Guide, any publication, you can see the forecast. And right now, 2021, everybody is coming and putting what's their forecast for shares. Right? But again, at the end of the day, those are all forecasts. In 2020, everyone's forecast had gone for a toss. Not once, but twice. Anyone who had forecasted what will happen in the markets knew nothing about pandemic. So companies like Goldman Sachs had to change their forecast 4 times in 9 months. So that clearly tells us whatever we may try, we have no control on what will happen in the market. So that's why I want to sell options so that I always have a room for error because I don't know where the stock will go. And when I'm selling an option, at that point of a time, I define what's the amount of money that I can make. And that is why I want to do it at the best possible time and the best possible pricing. That is why the opening trade is the most important step in an option trade cycle. First step, first criteria. And if you want, take a post-it or a notebook, start writing these criteria because literally that's what I did. When I had started trading options, I had this written in a post-it and stick it on my laptop or computer monitor so that if I'm opening a trade, I go through these criteria list mentally. And once you do it 5 times, 10 times, 15 times, 20 times, it becomes a muscle memory. Right? Now, I don't have to go through these like literally looking at position sizing and next and next and next. I'm looking at my portfolio. I already know on the back of my mind, what's the impact of where does this particular trade lies on all these criteria. But that comes with muscle memory. So you have to make it as a muscle memory. And for that, won't hurt you if you take a post-it and start writing these criteria. So number 1 is position sizing. Position sizing, I mean, is the amount of the risk on any one stock ticker. It could be FB, Facebook. It could be FUBO. We did an example of a FUBO trade. Or it could be any one of your favorite stock. Don't let the risk of any position to be more than 5 to 10% of your overall net liquid value of your portfolio. I don't care how attractive the trade might look like to you right now. But if you already have, say you already sold 2 contracts of put option on Fubo TV, we did just now. And now you're thinking that, oh, I think this Fubo TV is going to go higher. You want to do 2 more contracts. But imagine 2 contracts means it's $5,000 is being blocked. If you sell a naked put option, you're in a cash account. I'm not talking about margin account right now. It will be $5,000 being blocked. And if your overall portfolio size is $50,000, you already reached 10% threshold. So at that point of time, I don't care what CNBC has to say, or what other investors or analysts have to say about bullish thesis on Fubo. I've reached my 10%. I'm not going to do any more bullish trade on Fubo. The reason is because irrespective of whatever any analyst say, we still don't know where the stock will go. Now, again, this criteria is in its order of importance. So top position sizing is the top criteria. Don't ever violate it. Because if you are right on position sizing, man, if you go wrong on everything else, we're going to talk about other criteria. We're going to talk about strike prices. We're going to talk about amount of premium you got, pick up a strike option, pick up your expiration period. We're going to talk about which stock you want to pick. If you are right on this, and if you go wrong on every other criteria, you will still survive to fight another day, to trade again. But if you are wrong on this, then nothing else would matter. In my years of options, if someone asks me what's my biggest lesson, I'm like position sizing. And if I go back and look at any of the trades where if I've lost sleep on it, it is because I've gone too big for my portfolio. Nothing else. If on some position, if I'm losing sleep, only reason is that position is too big for my portfolio. I shouldn't have done that. So all the negative news that you see, I was grabbing headlines on Wall Street about why option trading is risky, why option trading is not for retail investors, why options should be left only to professionals. It is all because people violate this rule. I mean, I love digging into those reports to go deeper to understand why they lost this money. And most of the time I find because they became too big. And this is not only mistake which rookies make. Seasoned option traders make the same mistake and get burnt by this. It's greed. An example I'll give you, which is in 2018, there used to be a hedge fund called OptionSellers.com. They in fact wrote a book on option selling. That hedge fund used to manage $150 million for around 200 plus clients. And within 2 days, they lost everything. Everything. The owner came on YouTube and later on lawyers took that video off YouTube. But now, once on the internet, it lives forever. So that video is still popping up at multiple places. The writer of the book and the owner of the hedge fund, the promoter of the hedge fund, created an apology video saying, we messed up. And once we looked at why happened, They had a huge position in one ticker, which is called natural gas. And natural gas had blown up suddenly and they had to just fold up. So this happens even with experienced traders. So that is why this is the most important rule. Everything else they would have done right. Those are professionals. They've been managing and doing options for years. They in fact wrote a book on option trading. But sometimes greed get better of them and the hedge fund had to fold up. Okay. So the most important lesson, most important criteria is position size. Later on, in maybe some other subsequent session, or if there is a interest, I can show a little more mathematically why this is so important. Because options is based on probabilities, and the probability of you getting 20 high probability trades, all losing everything, is infinitesimally small. So, but if you've done only 2 trades, both of them can go completely wrong and you could lose 100% on both of them. The probability of that having is bigger. But having 20 high probability trades is very less. So that's why you'll still survive. So don't ever violate this rule. And if you are thinking, come on, it's okay, I can take care of with big positions, then you can drop off from this session. You don't need to go through the rest of it, because this is the most important one. Okay, next one. So now, say you're looking at a particular ticker. Let's take case of Fubo. I give you a trade. You're looking at, okay, Vivek is asking me to sell a put. I don't have any positions on Fubo. Selling one put means $2,500. It's okay. I've got $50,000 account. It's less than 2%. I'm fine. Good. Next, you should look at your asset diversification. Right? I asked you to do a trade on Fubo. You should have already looked at it. Fubo is in which industry? It's in streaming media industry, kind of equivalent to, say, other streaming players. Do you already have some of those streaming players in your portfolio? If yes, then should you really do Fubo? Probably not. Similarly, if you already have enough of tech, metal, financials, again, this is the general asset diversification, not specific to options. But don't get over concentrated or don't do trades only in techs, only in metals, only in financials. 2020, if you were overexposed on financials and energy, it was a killer. They haven't yet recovered, even though the other sectors have recovered. You could come back and tell me in 2020, I should have been completely tech. Because NASDAQ was up 44%. But you never know what 2021 may bring. By the way, I was able to even beat NASDAQ without having that concentration on NASDAQ. Because in options, we can do way better without getting over concentrated. So look at your portfolio. So your question that you should have gone through, I hope you will go through next time I give you a trade is, do I already have enough of this sector in my portfolio? If yes, ignore it. There are more trades available. There are many more trades which are available. You don't have to do that. Yeah, why do you need another trade if you're already overexposed? Right? So avoid overexposure to one particular sector. Keep a balanced portfolio. It doesn't mean that you should have, not have any sector, or you cannot have more of one sector, but don't have, let's say, 90% in tech or 100% in tech, or 90% in financials. Keep some balance. So you got a FUBO. It's within your position sizing. You don't have any other of the streaming medias. You don't have, let's say you don't have a Disney, or you don't have Netflix. You say, okay, I'm ready to do trade on FUBO. Now, next thing is the stock should be very liquid. Liquid means in the market, there should be enough interest, or the enough number of trades or shares should be traded in the market. When you look at a liquidity for a particular stock, there are two things that we need to look at. One is that the base stock itself should be liquid, means maybe at least or around 500,000 shares should have been traded for that day. Or on an average, you should see that those many shares are being traded. FUBO traded a few million shares. So from that perspective, yes, it is liquid. Other thing you could look at, because we are selling options, we also need to look at, is there enough liquidity on the option? So for the February, near at the money strike price, so I gave you the strike price of 25. Look at 25 and see whether there is enough volume, option volume at that strike price. 100, 60, 70, it's fine. It's just a guideline. There is no specific science or rule on this one. So it means if you have enough strikes, enough volume, it means then the stock is liquid. If the stock is liquid, the bid-ask spread on the strike price will be tight. Tight means maybe a few pennies difference, or a dime, maybe a 20, 25 cents, 30 cents difference. If the stock is not liquid or the option is not liquid, you will see that the difference between the bid and the ask on your strike price would be $1, $2. So if the stock itself is $1,000, say Amazon, in that case, I understand that the bid ask could be $2, $3, $5. But for FUBO TV, it's what, $25 stock. In that case, the bid ask should be tight. Now, the reason why I insist on this bid ask should be tight is, number one is, in case if you change your mind, so the difference between the bid ask spread is called slippage, which is kind of a ticket charge that you pay to get in and out of a trade. So say you sold a put on FUBO 475, and if the ask is $5, you change your mind after that. Immediately you sold a put and you changed your mind. So, I want to get out of it. And you want to buy it back, you will have to buy it back at $5. So you just lost 25 cents. It is the ticket charge just to get in and out of trade. So if the bid-ask spread is tight, which is what happens in many of the liquid underlines, the spread would be penny or 2 penny wide. In that case, people say, oh, market makers have an edge over us, or the professionals have an edge over us. They probably have an edge of a penny or 2 penny. You get into a trade. If you don't like it, close it. Things like Apple, you can buy it back with just by a difference of a penny. Number two, if there's a liquidity, then it'll be easier to manage the trade. And we will talk about the details of trade management in later sessions. But say in a FUBO, you sold a put. It was a bullish trade. FUBO doesn't know that you put a bullish trade. It starts to go down. We'll manage the trade. So when you're managing a trade, There are techniques to do it in which, you move your strike prices and all that stuff. And if there's enough liquidity, it will help you in managing the trade because you will be able to find other strikes where there's enough volume. So look at the liquidity of the stock. Some of these tickers, they are all highly liquid. So if you are creating your watch list for trading options, whatever scanner you use, in that scanner, put some of these criteria that 50-day or last 60-day average trading volume of stock is $500,000. Use those criteria to find out the very liquid trades available for options. See a question in an option change, volume in 3-digit is high. Yes, that's decent enough volume. Also, what is open interest? Open interest is different from volume. Open interest shows how many contracts are still open at that strike price that may not have been traded today. So for example, if you opened up the short put on Fubo, you added 1 to that open interest. So tomorrow, your contract that you opened up still shows up, still adds 1 to that open interest count. But tomorrow you may not be doing any more Fubo. So you will not be contributing anything to the volume count, but your opened put that you already opened today, that will still show up over there. So I focus on volume because it means at least today when I want to do the trade, there are participants who are participating in the market. All right, so this is a TD Ameritrade Thinkorswim, and they have a paper trading, so you can become comfortable by looking at the paper trading. See, let's look at Facebook, right? Front month, 19th Feb is a front month. I'm looking at 1000 volume, 1200, decent enough volume over here. That's why it's very liquid. Look at the stock volume. It is like almost 10 million stock trading. Let's look at Apple. Front month, 1000 being traded. 97 million stocks being traded. Many of these ETFs or some of these big, they are all very liquid. And these generally, Apple, Bank of America, Tesla, SPY, which is S&P 500, these are all generally the top rated, the top traded tickers on US exchanges anyway. And that's why they're very liquid. Now, XLV, XLK, all these are sector specific ETFs. Again, these are one of those standard tickers on which I would always like to have positions. Let's take a few more examples. Let's look at GLD. Again, 12 million stock traded, decent enough option volume. We see 1,000, few hundred, decent enough option volumes. Bid ask spread, 5 cents, 10 cents wide. Again, this also depend on the volatility. In that case, it will again become wider, but 5 cents, 10 cents, fine. Okay, so that is why the bid, let me give you another example for the bid ask spread. Mercado Libre, volume is very less. Look at the bid ask spread. The share volume is 530K. The option volume, almost zero. No one, it's not very active in option trading. In some strike prices, 23, 10, 7. Look at the difference between bid and ask spreads. $7 difference. So if I sell a put at 1650 and I change my mind, the next second I want to buy it back, I lost $7 or $700 right there. That's a ticket charge which I have to pay. That's a slippage. That's a difference between bid and ask is the ticket charge. So that is why liquidity is important. See a question. So this liquidity criteria specific to short-term trade as you're looking at current daily volume of liquidity. Now the short-term trade, when I refer to it, I generally look at 30 to 45 days trade. I don't do day trading. So I'm not looking to do the trades which I'm open today and close out, end of a day or tomorrow, etc. My general cycle is I'm looking at days to expiration between, I'll start opening the trades for expiration period around 55, 50, and then start closing the trades when it is either it has hit my profit target. We'll talk about this trade exit criteria. If it has hit my profit target, I'll close it. Or once it becomes closer to 20 days to expiration, I'll start closing it. So those, if you consider the short term, for me, those I don't consider them as a short term trade. Those are my regular monthly income trades. Let me put it that way. All right. So next one, again, this applies only for options, which is implied volatility. The next criteria to look at is implied volatility. So you'll say we looked at FUBO. You don't have any positions, so position sizing, good. Pass. We looked at you don't have any other stock in that same industry, good. Pass. Third thing, FUBO is liquid. Yes, it is. Few millions of shares were traded. 75 million shares of FUBO were traded. More than 1,000 options were being traded. Liquidity is good. Pass. Next, I'm going to look at what's the implied volatility on it. Now, I won't get into the details of how it matters right now. When we talk about option pricing, that time I will get into the details of it. But just understand the fact that it's a value that is available for options. So for example, here, if I were to know what's an implied volatility of FUBO is, I can go and look at option statistics. It will tell me implied volatility is 171.48%. If I want to know what's the implied volatility on Facebook is, Facebook's option statistics will tell me its implied volatility, IV, is 42%. So now implied volatility, higher the implied volatility, more is the premium. Because in an option pricing, this is one of the factors that goes into the Black-Scholes formula or binomial formula. Mostly it's a Black-Scholes is what's generally used for pricing options. So it goes into the Black-Scholes formula as one of the parameters. So if higher is implied volatility, more is the premium. Now, if I am selling option, I want to sell when I can get more money. I want to sell when the premium is, the premium available is higher so that I can sell it at a higher premium. And then when I have to close it, I will buy it back when the volatility decreases, and hence the price decreases because of volatility. I will buy back and close the trade. Remember, when we are selling options, we are selling to open the trade, and they are buying it back to close the trade whenever the trade has hit my profit target. So if you are selling when the implied volatility is high, means you're getting more premium. That's put us, we're putting our best foot forward. So then we have a more opportunity to make money because we collected more premium. Now, why the premium would be more? It is because the market participants are expecting that the risk is high. I was, happiest soul in March because the premiums were through the roof. On a $20 stock, I was able to get a premium of like $4. on a $20 stock, because market thinking that everything is gone, the hell has broken, and there will be no tomorrow. So we have more opportunity to make money when the implied volatility is high. And that's the time in which I would want to scale my trade. So now this IV is specific to each stock. So we really looked at Facebook IV is 42. Fubo IV was 171. Give me Apple IV is, Apple IV is 43. So now these are very specific to their own tickers. So now if you have to make a choice, should I do it on a Fubo now or not? You like 170 of Fubo, is it better than, let's say, IV for 50 for XLE? Indeed. Because, and I'll introduce another concept which will make it clear. When you're looking at an IV for a stock, you need to also know how it has been historically doing, right? Say if Fubo IV generally is 200% and today it is at 170, then today is not the optimal day for me to sell an option on Fubo. Because what if I sell an option on Fubo and it moves, IV rises, because most of the time it is at 200, it will rise to 200, that will go against me. If I'm selling an option, I want the option premium to start decreasing after I have sold. If it increase after I have sold, that is going against me. So I want to sell when the IV for a particular stock is at higher level than what generally it is. So if you look at an XLE IV is generally XLE IV, let's say it is 41. So if XLE is at 50, if I'm looking at XL is around 40, 39, 40, 38. So tomorrow if XL suddenly becomes 50, it is much better because now I can get much more premium. But if tomorrow Fubo becomes 100, it is not a good time to sell a premium or option on Fubo, because generally it's IV is around 150, 170. So if IV on Fubo is 100, it is lower than where it generally stays. So it's not a good way, not a good time to sell premium on Fubo. So now it means you need to understand what's the generally where the IV for each stock is in which you are interested. Then only you can compare whether today IV is it higher than general, is lower than general. Right? So for that, there is another concept called IV rank or IV percentile. I know some of you had asked earlier a question about, do I take IV rank into a criteria? So this is where the IV rank comes into picture. Because now, like I said, Fubo 100 is not good. XLE 50 is better than Fubo being at 100. So rather than you trying to figure out and have a chart or table for each of the stock and where their IVs generally are, it's best to look at an IV rank. Now, depending on which trading platform you use, not all of them actually shows you this comparative IV rank. But what IV rank does is it compares the current IV with the 1 year historical or IV. So if in last 1 year, and Fubo is a wrong example because it has been existing for 1 year, but say it has been. So in the last 1 year, FUBO has been on average around 160, and today it is 100, then the IV rank will tell me that it is way below. The rank will be very less. XLE, IV generally has been around 40, and today it is 50. The IV rank will be higher than, or will be way higher. Okay. So the IV rank will compare the current IV with 1 year historical IV. So if you're on a Tastyworks platform, they show IV rank upfront. If you are on a TD Ameritrade platform, they show IV rank but with a different name, which is called IV percentile. So which is 19. So if you look at a FUBO, it is 171, but it is a 19 percentile. Means it is not at the best of IVs. Let's look at XLE. It's also 19. Look at Apple. Apple IV is 43. It's at 24 percentile. So you could use that percentile. If you are on Tastyworks, they will show you IV rank upfront. Now, if you want to know the formula, ping me separately. I can share you how to calculate it. You need to know the last in 252 days highest IV, 252 days lowest IV, and then basically we figure out where does the current IV lie, looking at those two. So higher IV rank means that today is a better day as compared to past 1 year, right? So generally, if I'm looking to sell an option, I will look at a higher IV rank, higher than 40 is fine. Now, once I know 40, it means 40 IV rank on XLE and 40 IV rank on FUBO. It means I have equal probability of making money in both the cases, not the dollar amount, but my trade setup so that I can make money is equally good in both of them. So any IV rank higher than 40 is great. Sometimes even 30 is fine too, because generally IV doesn't stay high. 2020 has been an aberration. This is not how the stock market behaves. I remember trading in when the IV or the VIX, which is the volatility of the S&P 500 or SPX, used to be in a single digits, 7, 8, 9. I used to be happy if VIX is like 12. Hey, we got better opportunity. But we made money even in those cases also. Now, 2020, VIX has never gone below 20. But these days don't last always. So if IV rank is 30, it's fine. In today's cases, IV rank even 25 is good enough because of what happened in March. The whole rank has been skewed. So today, if I'm looking at any, trying to put a trade and I look at an IV rank and say 20, probably I'll still go ahead and put it. Because I know that in March, the highest IV could have been like 100 because everything was imploding. So volatility was through the roof. And that is why when you start comparing with that, today's IV rank could be, today's IV could be looking at very low, and that is why the rank is so less. So today I will do at 25 also. But 6 months later, once the March is outside of that calculation, I'll probably wait for it IV rank to be 30. I know this is little detailed topic, but it is important. This gives us more probability to make money on our option trades. So that's why first you looked at position sizing, asset diversification, liquidity. Now you see, is it good time to put a trade on this one? What's their IV rank? If it is around 20, 25, So tomorrow, if you're looking at it, 2025, I would say it's a good time to put it. I see a question. IV being also means stock will have large movements in either direction. That is why the volatility goes high. And that is why the IV is high. Yes. The implied volatility, right? The implied people are thinking, the market participants are thinking that it will make larger magnitude movements. Okay, any more questions on IV? I see a question. How do you know the historic average IV if not tracking the stock regularly? Okay, so we already talked about IV rank and IV percentile. These are the two values that you can use. So now you figured out that it's good for your position. It's good for for asset diversification, and it's a very liquid stock, and IV is also high. Now we should look at option strategy. Right? What option strategy you're gonna use come way down the line, and that is why when someone asks me, "Can you tell me what ticker and what strategy you use?" I generally don't want to answer that question. When someone asks me, "Tell me your trade on Fubo," I don't want to answer it because I don't have any information on the top other three criteria. How does it apply to your own portfolio? So now you look at an option strategy. Now you want to think, if you are bullish, you have our options, right? You can do naked put, or you can sell a cash secured put or a put spread. And again, all the trades that I'll be talking about is as an option seller. If you're bearish, you can sell a naked call, not for beginners, rather sell a call spread. If you're a neutral, you don't have any specific directional opinion on the stock, sell an iron condor, sell an iron butterfly, or strangle or straddle. If you are just starting your option journey, you probably will not be allowed to do strangle or straddle. So you will be doing iron condor and iron butterfly. Again, we'll get into the details of these in subsequent sessions. If you're slightly bullish or slightly bearish, now the great thing about options is that you can express your opinion in multiple ways. Okay, I'm too bullish on it. Okay, you can express your too much bullishness. I am slightly bullish. I can express my slight bullishness using options. In the stock, that's not even a choice. If you buy a stock, you are bullish. That's it. You should also select your option strategy based on how it impacts your overall portfolio. We're going to talk about more about this when we're talking about how to manage your overall portfolio in an advanced section. But I thought I'll just kind of hint this is the trade that you're thinking to do, does it help your overall portfolio direction? And there are many examples wherein I have led a individual trade which looks good because it had passed all the above criteria. But I did not do that trade because it doesn't help my portfolio. If my portfolio is already too bullish, and now I know that Fubo, I don't know why I picked up Fubo, but anyway, now it's stuck with me. So let's take a Fubo. Now I figured out, hey, you know what? I want to do a bullish trade on Fubo, but my portfolio is already too bullish. Then probably I'll not do it because that will make my portfolio more bullish. Now I want to maintain, depending on what's your outlook is. If your outlook around the market is too bullish, go ahead, do all the bullish trades. I generally try to keep a little balanced portfolio because again, I don't know where the market will go. So I want to make sure that my portfolio is balanced so that if the market goes little low, it goes down, I'm not hurt too much. It goes up, it's still fine. I don't lose too much the opportunity, right? So even if I have my portfolio is already too bullish, and I find this FUBO trade which I'm selling a put because I know FUBO could go high, probably I'll skip that one, right? So you need to move away from my individual trade over to your portfolio to see, is it helping your overall portfolio direction or not? Based on that, now looking at your outlook on the stock, then you pick up your option strategy, how that um, strategy will work out. Now you can pick up bullish, bearish, neutral, slightly bullish or slightly bearish. Then you look at a days to expiration. What expiration date should I do? Now weeklies I do only if I'm playing earnings. I don't do weeklies because the gamma risk is too high, because I have not introduced gamma yet, so I'll stop right there. The positions move too much if you're as it gets closer to expiration. So if you're doing weekly, then you need to be hawk-eyed on your monitor. You need to be always monitoring your position. Right? If you're a part-time option trader, you got a jobs to look at, or you got a business to focus on, got a family to focus on, ignore weeklies. I do only weeklies if I'm doing a specific earnings trade, because then once the earnings is done, I'm out. Otherwise, I do regular monthlies. 19th February 2020 is where now I'm putting my portfolio for all my trades are for 19th February 2020. 95% of the trading that I do is on monthlies. The third one is a leaps, which is go out 9 months, 12 months, 24 months out, right? If you let me open up, see if you're on which is this Apple, there are options available for 17th March 2023. Now, how do you decide which one to pick up? Should you do 5th Feb? Should you do 12th Feb? Should you do 19th Feb? My main, the best one which I do where mostly I play is the regular monthly cycle. Or should you do leaps? Leaps have a place, but it's only if I want to substitute my stock. And again, if you are doing leaps, there is a way to trade leaps on how to reduce your cost basis. Otherwise, I don't like leaps. So there's a separate, I think on a YouTube, there's a video I did long back for similarly again for one of the sessions was how to trade leaps. What's the right way to engage with leaps? So like I said, 95% of my trades will be regular monthlies. If I'm interested in earnings or a very specific corporate event that I want to play, in that case, I might look at an option which is closest to that corporate event. Leaps is instead of buying a stock, if I want to have a stock like exposure for longer duration for 2-3 years, in that case, I'll buy leaps. I see a question, how do you determine? So we'll come to that. Next comes the strike price. Now the next one is, which one should you pick? Should you pick at the money strike? In case of Apple, if I'm looking at here, should I sell this put? Or should I sell this put? So that depends on how bullish you are, right, on Apple. So if I'm selling this put, I'm collecting say $6.60. I'm selling 130. It means my break-even point here is 130 minus 660, $23, $123.40. If my thesis around Apple is that for next 45 days, it will stay above $123.40, I'll do here. But this means I am more bullish as compared to, say, if I sell 120. If I'm selling 120, say we collect it to 290, In this case, my break even is $117.10. I want Apple to stay above $117.10 for this to stay profitable. Of course, I'm collecting my dollar amount profit is less. It's only $290. In this case, my amount of money I'm making is $660, $660. But now when you're doing a closer to add the money, it's more bullish than if you're doing far out of money. Now my sweet spot, if I am, say I'm looking at a particular ticker, I think this stock has got a potential. I want to initiate a position in it. Most of the time I will do around 30 to 35 delta. I didn't want to talk about delta because we haven't just spoken about Greeks yet, right? So, but we look at a delta and then take it. Okay? But for now, understand, we'll get into delta a lot more details. The delta tells you tons of other stuff. It's the most important Greek. So I have one session only talking about delta. So just understand for now, if you are getting closer to where the stock is currently, your conviction needs to be stronger and stronger. So if you're selling a put here, means you're very sure that Apple will stay above, let's say 130 or 125, right? Or me, if I'm selling it here, I'm getting 290. I'm like, Apple will stay above 117. So for me, I'm not as bullish as you are because I think Apple can go down to 125. But I'm still okay because my break even is 117 if I sell 120 put. So I'm less bullish than you are. So depending on how bullish you are, you go ahead and sell, pick up the strike price accordingly. Okay, so we spoke about delta, right? What delta? So that if when you pick up a strike price, you can figure out delta. So I generally like, if I want to open up a position, I generally do 35 delta. Okay, other thing when you're looking at your strike price is check if the same strike price exists in back month. Means if 19th February, I want to check if on 19th March, do I have 130 price? Now in a stock like Apple, you will always have. That's why it is very liquid. And that's the beauty of why we want to trade on liquid stocks. Oh yeah, 130 strike price exists. With it, say I'm doing HQY. I want to sell 70. Let me go back and look at in the March. Does 70 exist? It exists. Now the reason is, if you find that this exists, when you're trying to manage your trade, one of the technique is to roll out to expiration. But if the strike price doesn't exist, then you're kind of stuck. So you won't be able to manage the trade well if the strike price doesn't exist in the back month, means in the future month expiration. But if you are done a good homework on the criteria number 3, which was liquidity, then you won't even end up into this problem that the strike price existing in a back month. Those generally would be. Okay, so I see some questions. Is higher IV good when buying calls as well as? No, and that means you are actually paying more. If the IV is higher and you're buying, it means you are paying higher. You're paying more than what generally it is worth in normal times. So I don't want to pay more. So when a high IV is higher, I'd rather sell premium. The question was, how do you determine delta to buy? Already answered. Using leaps instead of stock looks like a good way to be capital efficient. Yes, it is. And again, like I said, there is a complete separate session on leaps in terms of how deep in the money you should go. Should you do at the money leaps? Should you do deep in the money leaps, etc. But yes, I do use leaps for capital efficiency. Uh, on the question, to be clear, your ideal delta is 30 when selling, not buying. Correct. Correct. Buying, I very rare cases I buy. Not that I don't buy, but those are like maybe 1% or 2% of my trades where I would buy options. So most of the time when I'm talking default, please assume that I'm talking about option selling. So that's what I generally do. And I don't have, I may not be even, I'm not the best person to guide you in terms of if you want to buy what delta you should buy, because I don't know. I don't have much experience on option buying. So last one, overall buying power consumption. Now, this may not be applicable if you are just starting an option journey, because you may not have margin account, or you may not be allowed to do the trades wherein uh, the amount of money blocked is less than the overall risk. But for those who are trading on margin, understand that if you add this trade, how much is your overall buying power? Buying power means how much is the money available for you to do further trades. How much of that is being reduced? Now let's take an example. Oh, yeah. So in this case, on this simulated one, I have what option buying power 22,000. Right? Now, if I'm say selling this, it tells me that by buying power effect is $6,000. Means by doing this trade, I am reducing my buying power about another 6,000. Let's say sell it. It has gone to $15,000 now. My overall net liquidity is $25,000. Now my remaining buying power is $15,000. Say I want to do Apple. Now someone tells me Apple is great. We should do Apple trade. I go ahead and do this Apple trade. Now my buying power is $3,000. I shouldn't have done the Apple trade. Let's get back to before I send the Apple trade for execution, I should have looked at how much buying power is this Apple trade is consuming. What will be my remaining buying power if I sell the Apple trade? Prior to me selling that Apple trade, my power remaining was $15,000 out of $25,000 account. The moment I sold that Apple option, my buying power now is $2,000. I don't want to let my available buying power drop below 50% of my net liquidity. So again, this is applicable for those who are trading on margin. So if you don't have margin, then the amount of money blocked will always be what the max risk is. But if you have a margin enabled, and margin is a good thing, I like that. But it can cut both ways if you don't take care of your available buying power. If you're trading on margin, make sure that the option buying power available doesn't drop below 50% of your net total liquid, right? So let me give an example. Let's cancel this. So now my buying power available is $15,000, and assume that this is a margin trade and net liquidity is $25,000. Fine. I could do another few trades so that the buying power doesn't go below, $12,000. I want to maintain at least 50% of buying power always available with me. Now, this is a very hard concept to grasp if you are coming straight from a stock investor towards option selling. The reason is, in the stock world, I was told, and I still believe, that cash is trash. Right? We always want to stay invested. Cash doesn't earn anything. So why keep so much of a cash on the side? If I'm talking to someone and figure out that you got a 50% cash sitting on the side, you're not using 50% of the power available to you, and you just kept on the side and you have you're only invested 50%, what the hell? How are you gonna, beat the market? Or how are you won't even be able to match the market. But when we are dealing with option selling, it is very important. If you're on a margin trading, again, this applies only to those who are on margin, not on cash account. But if you're on margin, don't over leverage it. And you will still be able to beat the market. So keep an eye on your overall buying power. We'll talk more about when we talk about a risk management on using options. We'll get into more details of this. But the example that I took, I shouldn't have done Apple trade. But could I do another, trade for this one? Let's say create duplicate order. Maybe add a strike price. How much margin is going to consume? $3,000, 15, 12. Fine. I could do this, but I shouldn't have done the Apple one. This will help in avoiding all what people call margin calls, and then all the show that happens when the brokerage liquidate your portfolios, etc. You will avoid all those issues. And especially when you're not full-time, why even we can't monitor every day. So why even do that? So option selling, if you're selling options on a margin account, keep an eye on overall buying power. Yeah. But if you're on a cash account, then anyway, you won't be able to do trades which have a more risk than what the money you have in your account. But if you are on margin, the amount of risk you can take could be more than the amount of money that you have in your account. And that's where you see the story of not only I lost everything in my account, but I had to, put more money and give more money to brokerage because you are not keeping an eye on how much you are using. Right? So those are all criteria in the sequence. So note it down if you haven't put it on Post-it yet. Position sizing, portfolio fit, liquidity, IV or IV rank. Then pick up what the strategy is, what's the expiration, and what the option strikes you want to use. So next time you're asking someone, don't just ask about, yeah, tell me what strike and date I should use, because you don't know all the other things. How much do they have already in their positions, right? I might be doing 5 contracts of it because it's okay for my portfolio value. It may not be okay for your portfolio value. You may have to do only 1 contract. Right? It fit my portfolio because I don't have any more tickers over there. But it would fit your portfolio. It may not fit your portfolio because you already got similar tickers over there. Right? And overall buying power consumption. You do not have portfolio direction. Most of the time, I don't have a very strong portfolio direction. I always try to bring my portfolio to be directionless or lesser bullish or lesser bearish. I don't want to keep too much direction. My portfolio tilted too much directionally. Because in an options, we can make money on theta decay. We don't really have to make money on directions. There are other ways to make money on options. And I want to focus on that because I don't control where the stock will go. So I don't want to create my portfolio assuming that the stock will only go high or the stock will only go low. I don't know where it will go. Okay. All right. So that finishes our first session. It took much longer than what I thought it would. We are 7:50. So the next session I wanted to talk about was small account trading strategies, but I don't think we'll have time for that.